What if I told you the next market crash isn't just likely, it's a certainty? And if you're not ready, you'll end up being someone else's liquidity. That's a harsh truth, but it's the foundation of how Wall Street titan Ray Dalio thinks. He doesn't try to predict the future. He designs portfolios that are practically indestructible. See, Dalio's core philosophy is simple. A market crash isn't a matter of if, but when and where. For him, the biggest risk isn't just losing money, it's losing your ability to recover, both financially and mentally. This is a game changer. The old advice to buy when prices are cheap is a relic. Today's investor has to be more like an architect, carefully constructing a portfolio that can weather any economic storm, from blistering heat to a deep freeze. He calls this the all-weather portfolio. We're going to unpack one of his most powerful principles for building a resilient portfolio, a strategy he calls spreading the pain. It's a game changer, and by the end of this video, you'll see investing in a completely new light. So what does spreading the pain even mean? It's about building a portfolio that can withstand any storm. Most people think they're diversified because they own 10, maybe 20 different stocks. You might have some tech, some healthcare, some consumer goods, and you feel safe. But Dalio would call this an illusion of diversification. Why? Because when a real crisis hits, think 2008, think the flash crash of 2020, what happens? Almost all stocks fall together. The correlation between them shoots up towards 1. That tech stock and that consumer goods stock suddenly start behaving in the exact same way. They both plummet. Your so-called diversification vanishes right when you need it most. You're not diversified, you're just holding different flavors of the same risk. This is where Dalio's genius comes in. He doesn't think about diversification in terms of individual stocks. He thinks in terms of uncorrelated assets at a macro level. True diversification isn't about owning different companies. It's about owning assets that react in opposite ways to the same major economic events. Let's break that down with a simple example. Imagine a sudden, unexpected surge in inflation. What happens? Typically, the value of your stocks gets crushed. Companies face higher costs, consumer spending power drops, and the future earnings everyone was so excited about are now worth less. So, your equities take a nosedive. But, at the exact same moment, what's happening with other assets? Commodities, like oil, gold, and agricultural products, will likely soar in price. Their value is directly tied to inflation. Similarly, inflation-linked bonds, or TIPS, are designed specifically to protect you from this scenario. Their principal value increases with inflation. See the magic here? While one part of your portfolio is getting hammered by inflation, other parts are thriving because of it. The gains in your commodities and TIPS can offset the losses in your equities. This is what Dalio means by spreading the pain. The pain in one area is soothed by the pleasure in another. You're not trying to avoid pain altogether. That's impossible. You're engineering a system where the total impact is neutralized. Dalio's strategy is often called the all-weather portfolio for this very reason. It's designed to perform reasonably well no matter what the economic weather is, sunshine or hurricane. He achieves this by building a portfolio from about 15 to 20 independent, uncorrelated bets. Notice the language here. Bets. Each position is a bet on a certain economic outcome. But because these bets are truly independent, the failure of one doesn't cause a domino effect that takes down the others. The key insight is that the goal of this strategy isn't to hit home runs and maximize returns. It's not about finding the next Tesla or Amazon before anyone else. The primary goal is to minimize drawdowns. It's about survival. It's about making sure your portfolio is still standing when the world seems to be breaking. Because what's the number one killer of long-term returns? It's not picking the wrong stock. It's being forced to sell at the worst possible time. It's the panic that sets in when your portfolio is down 40% and you capitulate, locking in those massive losses. Dalio's approach is a psychological firewall. By building a portfolio that doesn't experience those terrifying drops, you remove the emotional impulse to panic sell. You can stay the course, confident that your portfolio is balanced for whatever comes next. So how can we, as individual investors, apply this powerful principle? This leads us to the first actionable rule derived from Dalio's philosophy. Hold assets that perform well across 4 major economic environments. Think of the economy as having 4 seasons. First, you have periods of rising economic growth. Things are booming, companies are profitable. What does well here? Equities or stocks are the clear winner. Corporate bonds also do well. Second, you have periods of falling economic growth or recession. In this environment, people get defensive. They flee from risky assets and seek safety. This is when government bonds, especially long-term treasury bonds, shine. As interest rates are cut to stimulate the economy, the value of existing bonds goes up. Third, you have periods of rising inflation, like we talked about earlier. Cash and traditional bonds get devalued. Here, you want to own inflation-linked bonds. Tips: commodities like gold and oil, and even emerging market currencies can do well. And fourth, you have periods of falling inflation or deflation. This is a rare but destructive environment where prices are actually falling. In this scenario, cash becomes king because its purchasing power is increasing. Long-term government bonds also do extremely well. The all-weather strategy is about holding a piece of each of these puzzle pieces at all times. You have assets for growth, assets for recession, assets for inflation, and assets for deflation. Why? Because you, me, and even Ray Dalio himself cannot predict which of these environments is coming next. The future is fundamentally unknowable. Instead of trying to be a forecaster, you become a strategist. You acknowledge that you don't know what's going to happen, so you prepare for everything. You build an ark before the rain starts. This balanced allocation ensures that no single economic surprise can wipe you out. Some of your bets will be wrong at any given time, and that's okay. That's the point. The pain is spread so thin across your portfolio that it becomes manageable. This is the foundational rule of building a truly resilient investment portfolio. It's not about chasing trends or getting stock tips. It's about understanding the deep structural forces that move markets and positioning yourself to be indifferent to them. It's a shift from being a speculator to being an architect. By diversifying across economic environments, not just across company names, you build that crucial psychological firewall that protects you from your worst enemy, yourself. You can sleep better at night, knowing that you are prepared not just for the weather you expect, but for any weather that comes your way. Have you ever heard the saying, "Don't put all your eggs in one basket"? It's probably the first piece of investment advice anyone ever gets. So, you do the sensible thing. You take your hard-earned money, say $20,000, and you split it. You put $10,000 into stocks and $10,000 into something safe, like gold or bonds. You feel smart, you feel diversified, you feel safe. You think you've perfectly balanced your risk. Well, I'm here to tell you that this common sense approach, this Wall Street wisdom, is dangerously wrong. You're not balanced at all. In fact, you're sitting on a financial time bomb. Let's break down this illusion of safety. What you've balanced is the dollar amount, but you've completely ignored the most critical factor in investing: risk. And risk isn't measured in dollars, it's measured in volatility, the wild swings in an asset's price. Here's the kicker. Stocks are historically 3 to 4 times more volatile than assets like gold or government bonds. Think about it like this. Imagine you're balancing a seesaw. On one side, you place a calm 10-pound cat. That's your gold or bonds. On the other side, You place a £10 Wolverine that's just had 3 espressos. That's your stock portfolio. They weigh the same, but which side is going to cause all the chaos? Which side is going to throw the entire seesaw off balance? It's the Wolverine, of course, that 50-50 portfolio you built. This brings us to a powerful mindset shift, a concept used by some of the most sophisticated investors in the world. It's called the risk parity mindset, and I like to call the core of it the reverse leverage principle. Forget about balancing dollars. True diversification, true portfolio resilience comes from balancing risk. The goal is to build a portfolio where each component, your stocks, your bonds, your commodities, contributes an equal amount of risk to the whole. So how do we actually achieve this mythical risk balance? It sounds complicated, but the principle is straightforward. If stocks are 3 times riskier than bonds, you shouldn't hold them in equal dollar amounts. To make them contribute equally to the portfolio's risk, you need to adjust their sizes. You would hold significantly less in stocks and more in the less volatile assets. Let's go back to our $20,000 portfolio. Instead of $10,000 in stocks and $10,000 in bonds, a risk parity approach might look something like this. You might only put $5,000 into stocks. Now, you have $15,000 left for your bonds. Instead of just buying $15,000 worth of bonds, you could use that capital to control a larger position. Sophisticated investors might use futures contracts, which allow you to control a large amount of an asset with a smaller amount of capital. For the everyday investor, there are now accessible tools like mild leverage bond ETFs. These funds are designed to give you, for example, 1.5 or 2 times the daily return of a bond index. So you take your larger allocation of capital dedicated to bonds and use a modest amount of leverage to amplify its risk profile until it matches the risk of your smaller stock allocation. You're essentially deleveraging your stocks by holding less of them, and then carefully, intelligently re-leveraging your safer assets to bring them up to an equal risk footing. You're re-engineering the engine of your portfolio. This might sound counterintuitive. Leverage? Isn't that risky? Yes, leverage can be a double-edged sword, but remember the context. We're not talking about recklessly borrowing to gamble on penny stocks. We are applying a small, calculated amount of leverage to the safest, least volatile parts of your portfolio. It's about being smart with risk, not just avoiding it. You are taking the stable, predictable tortoise in your portfolio and giving it a little jetpack so it can keep pace with the hyperactive hare. Now let's talk about the real magic of this approach. It's not about squeezing out an extra 0.5% of returns in a good year. The true power of a risk parity portfolio reveals itself during a crisis. Imagine the market plunges. The stock market is down 30%. In a traditional 50-50 portfolio, your stocks take a massive hit and your whole portfolio is likely down double digits. Panic sets in. You see your life savings dwindling and the primal instinct to stop the bleeding takes over. You sell your stocks near the bottom, locking in devastating losses. But what happens in your risk-balanced portfolio? Yes, your stocks are down, but they only represent a smaller portion of your overall allocation. At the same time, during these risk-off events, what do bonds and gold often do? They rally. People flee from risky assets to perceived safe havens. So, while your stock portion is taking a hit, your leveraged bond position is likely gaining value, acting as a powerful shock absorber. Instead of a 15% or 20% drop, your portfolio might only be down 3 or 4%. This is the psychological game changer. When you see a small, manageable dip instead of a catastrophic loss, you don't panic. You stay calm. You have the emotional fortitude to stick to your plan. You don't sell at the bottom. In fact, you might even have the confidence and the capital to rebalance, selling some of your winners, the bonds, to buy more stocks while they're on sale. You transform a moment of terror into a moment of opportunity. This is the essence of crisis-proof thinking. It's about building a financial ship that's designed not for calm seas, but for the inevitable storm. The traditional approach builds a raft with a giant top-heavy sail. The first big gust of wind and you're capsized. The risk-parity approach builds a modern catamaran, stable, balanced with multiple hulls to keep it steady no matter which way the wind and waves are coming from. It's about surviving the chaos so you can thrive in the recovery. So the next time you look at your portfolio, ask yourself a different question. Don't ask, are my dollars balanced? Ask, is my risk balanced? Stop thinking like a traditional investor and start thinking like a risk manager. By embracing this reverse leverage principle, you're not just adjusting numbers in a spreadsheet, you're rewiring your financial brain to achieve true stability and peace of mind, especially when the world feels like it's falling apart. Ever heard the Wall Street gurus chant, "Cash is trash"? It's one of those catchy phrases that sounds smart, right? It implies that if your money isn't working for you 24/7 in the market, you're losing out. And sure, during a raging bull market when everything is going up, holding cash can feel like you're standing still in a race. But what happens when the music stops? What happens when the party ends and the market takes a nosedive? That's when you discover the most powerful secret about cash. It's not trash. It's a superpower. It's what investing legend Ray Dalio calls optionality. And understanding this one concept can be the difference between getting wiped out in a crash and emerging from it wealthier than ever before. So let's break down this myth. The idea that cash is trash is only half the story. It's a boom time mentality. When stock prices are soaring, inflation might be eating away at the value of your cash sitting in a bank account. In that specific context, yes, you'd rather have your money invested and growing. But markets don't just go up, they are cyclical. They boom, and then they bust. And it's during the bust, the crash, the panic, that cash transforms. Imagine this scenario. The market has been on a tear for years. Everyone you know is a stock market genius. Your portfolio is looking fantastic. You're feeling invincible. Then something happens, a black swan event, a geopolitical crisis, a bubble bursting. Suddenly, the market plummets. It drops 30, 40, even 50%. Panic fills the streets. News headlines are screaming, crash and recession. Now, if you're 100% invested, what are you feeling? Pure, unfiltered fear. You watch your net worth evaporate day after day. The pressure is immense. You might be forced to sell just to stop the bleeding, locking in massive losses. Your financial dreams feel like they're turning into a nightmare. You have no options. You're just a passenger on a roller coaster heading straight down. But what if you had followed a different rule? What if you had kept some cash on the sidelines? Let's say you had 20% of your portfolio in cash. While everyone else is losing their minds, what's happening to you? Your stock portfolio is down, sure. That hurts. But your cash? It's safe. It's stable. It hasn't lost a single dollar in nominal value. But here's the magic. While its nominal value is the same, its power has just skyrocketed. Think about it. If the stock market drops by 50%, your cash can now buy twice as many shares as it could before the crash. The purchasing power of your cash, relative to those beaten-down assets, has just doubled. A 30% drop, your cash is suddenly 40, 50% more powerful. This isn't trash. This is opportunity. This is optionality. This is what we call holding dry powder. It's an old military term for keeping gunpowder dry and ready for a critical moment in battle. In investing, your dry powder is your cash reserve, waiting for the perfect moment to strike. Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates, lives by a simple rule. Never be 100% invested. Always keep some dry powder. Why? For two critical reasons. First, it allows you to be a buyer when everyone else is a forced seller. It allows you to rebalance mercilessly. When the world is panicking and selling their high-quality assets for pennies on the dollar, you can calmly step in and buy. You get to buy the same great companies you liked before the crash, but at a massive discount. This is the absolute core of the buy low, sell high mantra that everyone talks about, but so few actually practice. Having cash is what enables you to actually do it. You're not trying to time the market's bottom perfectly. That's a fool's errand. You're simply taking advantage of massive dislocations in price. The second reason is psychological, and it's just as important. Holding cash gives you peace of mind. It acts as a psychological buffer. When you see your portfolio drop, knowing you have that cash reserve prevents you from making emotional, fear-driven decisions. You are not pressured to sell your stocks at a loss, to cover expenses, or just to stop the emotional pain. You have a safety net. This mental clarity is priceless. It allows you to think like a rational, long-term investor, even when the world around you is consumed by short-term panic. You can stick to your plan because you have the resources to weather the storm. Now, when we say cash, it's important to clarify what we mean at a more sophisticated fund-level perspective. We're not necessarily talking about stuffing physical dollar bills under your mattress. When a large fund like Dalio's holds cash, they're often holding short-term government T-bills or positions in strong, stable currencies. Why? Because these are highly liquid, safe instruments that essentially act like cash but might pay a tiny bit of interest. A T-bill or treasury bill is a short-term debt obligation backed by the full faith and credit of the US government. They are considered one of the safest investments in the world. Their goal isn't to make you rich. Their goal is to preserve your capital and keep it ready for deployment at a moment's notice. So holding cash in this context means having a portion of your portfolio in assets that will hold their value or even increase in value during a risk-off event. When investors are fleeing from risky assets like stocks, it's your strategic reserve, your war chest. It's the tool that allows you to turn a crisis into an opportunity. Let's think about this practically. How much cash should you hold? There's no single magic number. It depends on your risk tolerance, your age, and your financial goals. Some aggressive investors might keep 5–10% in cash. More conservative ones might hold 20–25% or even more. The key is to have a deliberate strategy. Don't just end up with cash because you forgot to invest it. Deliberately set aside a percentage of your portfolio as your dry powder. This is the opposite of the get-rich-quick mindset. It's a stay-wealthy-forever strategy. It's about building a robust, all-weather portfolio that can not only survive, but thrive in any economic environment. The next time you hear someone say, "cash is trash," you can smile to yourself, knowing the other half of the story. You'll know that in a bull market, cash might be a drag, but in a bear market, cash is king. Cash is freedom. Cash is your ticket to buying wonderful assets at a wonderful price. It's the optionality premium that separates amateur speculators from professional investors. So, review your own portfolio. Do you have any dry powder? Are you prepared for the next storm, or are you 100% exposed to the whims of the market? Building that cash reserve might feel unproductive today, but when the next crash comes, and it will come, you'll be incredibly grateful you did. You'll be the calm one in the storm, ready to act decisively while others are paralyzed by fear. We've been breaking down Ray Dalio's timeless wisdom, and it all comes down to 3 core rules. But let's be clear, these aren't hot tips for your next stock pick. They're not about timing the market or finding a magical unicorn company. These 3 rules form a defensive system. Their entire purpose is to take you, your fear, your greed, your panic, out of the equation when it matters most. It's about creating a framework that operates with discipline. Whether the market is soaring or plummeting, think about it. When the news is screaming crash and your portfolio is bleeding red, what's your first instinct? For most people, it's to sell everything, to panic. That's emotion talking. The system, on the other hand, is built on logic and predetermined rules. It's designed to weather storms, not run from them. This is the fundamental shift in mindset that we need to embrace. We stop being traders, reacting to every headline, and start becoming architects of a resilient financial structure. A crisis, as scary as it sounds, is actually a predictable part of the economic cycle. What's more important is understanding what it truly represents. A crisis is a massive transfer of wealth. It is a shift of assets from the emotional and the unprepared to the disciplined and the systematic. It is a transfer from the gamblers who bet it all on one outcome to the system builders who prepared for all seasons. The question you have to ask yourself is, on which side of that transfer do you want to be? When you have a system, a market crash is no longer a personal failure. It's a test of your system's strength, and if your system is built correctly, it's also an opportunity. It's the moment when assets go on sale, when fear creates bargains that the disciplined investor can capitalize on. This is how generational wealth is not just preserved, but built. You survive the crash, and then you own the recovery. That's the ultimate goal, not to avoid downturns because you can't, but to be in a position to prosper because of them. Now I want you to do something for me, a little thought experiment. Pull up your portfolio in your mind, or even for real. Look at it. Now ask yourself this brutally honest question. If the market crashed 30% tomorrow morning, could you still sleep well at night? Would you be calm, knowing your system is working? Or would you be in a cold sweat, staring at the ceiling, wondering if you've lost everything? If your answer is anything other than a calm yes, then you've likely already violated at least one of the core principles we've discussed. You're exposed. You're relying on hope, not a system. But the good news is, it's not too late to change that. You can start building your fortress today. If you're ready to move from being a gambler to a system builder, I've got something to help you start. Subscribe to the channel right now, and as a thank you, I'll share a link to our sample all-weather allocation template. It's a practical starting point to see how these principles look in action. It's time to stop reacting and start preparing. Thanks for watching, and I'll see you in the next video.